So we're going to move on to Michael Mescher, and Michael is extraordinary uh, hedge fund trader. He's had a 570% return this year. Michael, we did a poll on questions that people wanted you to ask, and I think that people are very interested in special situations, et cetera. And also, any crypto special situations that may be existing. So why don't you introduce yourself, Michael? You've got the full 25 minutes, and we'll go from there.
Okay, perfect. My name is Michael Mescher. I run Gammon Capital. We're a derivatives trading firm. We specialize in AI and machine learning applied to the options market. We do a lot of quant work, and we also do a fair amount of special situations, which based on the questions, I think I'll touch on in just a couple minutes. Just as a quick background, as Marty had mentioned, last year was a great year. We put up about 570% gross. Prior to starting my own firm, I had worked as the head of special situations volatility trading at Lehman Brothers and then subsequently Barclays. So we've also got a great background and pedigree when it comes to some of these more special situations that we'll touch on in a minute. But before we get there, I think it's probably important to talk about the quant program that we're running. And this is really the bedrock of our program. I'd say about 90 to 95% of what we do is quant based in the option space. And when you take a look at the performance that we put up last year, that was largely driven by quant. We had a little bit of special sits in there, but that was largely driven by quant. So what I'm going to do here is I'm going to share my screen so that you guys can all see how we structure positions. Let's take a look at this one. Okay. Can you see that, Marty? Did my screen show up there?
Yes, it is. It says
great.
Sharing.
So what you're seeing right here is two portfolios. One is the blue line, which is our typical portfolio structuring. And then the orange line is the S&P. And the reason we put this up there is to really kind of give our investors an idea of what typical positioning would be like for our fund. So frequently, we're usually performing on the upside with the market on about a 2 or 3 to 1. And when the market sells off, if it's a transient sell-off, you're probably losing on about a 2 to 1 until you hit down about 7% or so. And then you start making money very, very quickly. And that's kind of what happened in 2020 or 2020. We had a couple of other interesting special situations that we were able to do well on. But it's important that everybody understand our portfolio and the perspective of these two graphs. The left obviously being a little bit more evidence of the tails and what happens when the market hits those really nasty black swans. And then the graph on the right is over there just so you can understand what a more normal environment is. So one of the questions that we typically get when we show this is, how do you construct these nonlinear returns? How are you able to protect these tails like this? And a lot of that really comes down to the way that we're leveraging the AI and the machine learning in the option space. Now, the great thing about options is that they allow you to have these nonlinear payouts. So you have a lot better control of your risk and specifically the types of rewards that you're looking for with this risk. When you run a long options portfolio like we do, we're frequently getting options that are available to us where it's a risk 1 to win 5 or 10 or 15 type of proposition. So when we construct our portfolio, we spend a lot of time interacting with our machine learning software, and that's able to go out into the options market, and it's able to assess all of the different investments that are available to us. Now, all of that is done in the context of the current market environment, and all of that is optimized towards what we believe are the proper investing objectives, and that's what led to the performance last year. So that's pretty much what our quant program is about. One of the other things I want to talk about a little bit is the special situation side. So we do special situations when they come up. It's not often, and it's a pretty high bar to get into the portfolio when it comes to a special situation. And by high bar, I mean, it needs to be an investment that's potentially going to be returning high double to low triple digits. Anything that's going to put up maybe like a 5–10% return isn't really worth the time, considering the other types of investments that we have. But one special situation that we spent a lot of time on last year, and it's actually going to be relevant in the coming year, is around the CARES Act. Now, if you guys rewind the clock back to March of last year, and you remember the original stimulus, it was called the CARES Act. It was a couple thousand pages long. And that got published. It's actually surprisingly difficult to find the full text of that document online, but with enough research, you're able to go find it. And we read through it, and we were looking for certain passages that would have presented risk in the markets. And we found some of those. Specifically, and you guys can check this for yourself, this is on my LinkedIn. but you can also go to the .gov website and check it on your own. If you go back to the CARES Act and you look at sections 4012 to 4015, effectively what it's saying is any requirements under United States generally accepted accounting principles have been thrown out the window for financial institutions in 2020. So basically what that means is any impaired debt that these financial institutions were carrying in 2020, as long as it can be argued that the debt has been affected by COVID, which is all debt, the people were allowed to carry that as fully performing debt on their books. Now, in addition to GAAP standards getting thrown out, FASB, the Financial Accounting Standards Board, those got thrown out. Any banks, whether it was a regional bank, community bank, or even the mega banks, to the degree that they fell in violation of their leverage ratios and a lot of the regulatory requirements, they all got grace periods. And a lot of people just aren't aware of this because nobody really went through these documents. I mean, in the 7 or 8 months that we were following this, we never really saw anybody else talk about this. And the reason this made the special situation bar for us is because all of this accounting treatment had an expiration date on it. And that expiration date was December 31st. So had the stimulus payment not been drawn out and extended, there would have been a very, very serious problem taking place in the markets this week because financials are starting to release earnings. This week, we would have gotten absolutely clobbered. And nobody knows about this and nobody saw it coming. Now, the interesting thing is, why hasn't this happened? It's because the stimulus got extended. And I talk about this a little bit on my LinkedIn page as well. You guys are all welcome to check it out. But suffice to say, all of that accounting treatment and the cooking of the books, if you will, is getting extended out for another year. So now it's not until January 1st of 2022 that this grand day of reckoning is coming. So that's one special situation that we thought was going to be more of a catalyst for last year, but it's going to be a catalyst in 2021. And we'll probably start positioning for that special situation probably around Q3 or Q4 of this year. Now, I know there was also—
Hey, Michael, just real quick. Yeah, I'm kind of old school, but we used to call something like this extend and pretend.
Yeah.
Okay, got it. Okay, that's all I wanted to know.
Yeah,
right.
you could say that for sure. Sorry, the sun's moving on me here. Let me try and get over here a little bit.
Great, keep on going.
You guys had also asked about special situations in 2021. In addition to the CARES Act extension, which is very material and definitely needs to be kept an eye on, we're also starting to venture out into the crypto space. We've done some work in there. We've had some interesting, very exceptional trades with phenomenal returns, returns that are not reflected in the fund stream because we have not run this trade through the fund yet. We wanted to make sure it worked first. And we're about to start running the trade through the fund going forward. But with respect to the crypto space, we've innovated a way to basically construct a risk reversal on the cryptocurrencies. And by risk reversal, what I mean is we have a way of structuring exposure to the crypto space where we're protected on the downside in case the crypto market ever starts to sell off, but we have significantly more upside return possible to us. So another easy way to think about this would be, say, like a call option on crypto, except these call options are very different than anything that you might ever find in some crypto listed exchange. The options that we're able to structure, for example, we're able to acquire certain cryptocurrencies for about 5 cents on the dollar. So this is a new special situation that we have done outside of the fund, but now we're going to include it in the fund going forward because it's been so successful. That's pretty much the 20,000-foot overview of the Quant program, and then a couple examples of special situations that we have. If there's any questions, I'm happy to start getting into those, Marty.
No, I think this is great, and I think it's really worthwhile that. So I guess my real question is, do you think that given the tenure of what's going to be happening with the Fed and this kind of regime of extension, do you think it's going to cause more volatility and more special situation opportunities?
So with regards to the special situations in the equity markets, there's still a couple catalysts that we've been paying close attention to that might lead to a little bit more volatility. These are actually the same 3 catalysts that we've been keeping an eye out and preparing for the past few months. One, obviously, the CARES Act, that ended up getting extended. 2 is the peaceful transition of power. We never expected the transition to be peaceful. As awful as the insurrection was, we were fully prepared for that. frankly a little bit surprised that the market didn't treat that more seriously. We think it's very evident that this is not going to be a smooth transition of power, even in the wake of what was recently said. So we're ready for about the next week of exposure. That's going to be pretty significant. And then in addition to that, we actually have, let's see, in terms of the risks.
I'm sorry, Michael, you're saying that this isn't over. That what happened?
No.
Okay,
No.
yeah, strange. Okay, no.
Yeah.
I mean, I hear the FBI reports, but it seems hard to believe.
Yeah, so the next week might be a little bit rocky just in terms of transition of power. Another risk is obviously COVID. As Biden comes into power and COVID's so widespread in the US, he's going to have to take a different approach to this. And we wouldn't be surprised to see if he starts tamping down on exposures. And one of the natural externalities there would be the market might sell off because it's expecting more of that kind of slowing down of the economy as people aren't allowed to go out and basically make exchanges. Now, whether that happens or whether none of these risks transpire and it's just straight right-hand tail all the way because all we're doing is printing money, the great thing is we have this nonlinear exposure where we're able to make money in both of those situations. Any other questions?
No, I think we need to go on. Keep on going.
Okay. So outside of that, like I'd mentioned, I want to talk about the crypto thing a little bit more. So in the structuring that we're doing, everything we're doing at Gammon is about structuring. We're less interested in picking winners and picking undervalued stocks. Like the equity long short's a very difficult proposition. I don't think returns are very special in there. A lot of what we do is more trading in the indices. But when you're able to get exposures like that, structuring is so important because if you're able to control that downside risk, then you have an infinite upside. And it's that asymmetry of the risk reward that really matters a lot here. Whether it's the equity exposure or whether it's the crypto exposure, everything is about installing certain structures where your risk is very limited and contained and your reward is many multiples of that. And that's just the great thing about the asset classes that we traffic in. It's the great thing about having 20 years of background in the space as we know how to go into new products and basically create these synthetic types of options. And it just gives a lot of very favorable risk reward. And that's where you really start to see numbers like what we put up, where it's perfectly reasonable to expect a double digit or low triple digit number. All of those are very much in the cards.
Hey, Marty, can I jump in with a